On today's live stream, I'm going to give a shout out to these guys. This isn't a paid sponsorship or anything like that. This is just a friendly shout out to AAA Jewelers. I'm going to hopefully get it in there so you can screenshot it or whatever to get the phone number. Mom was up there at, let me see if I got the name right. I think it's Arvada, Colorado, if I got this right. Mom was up there, checked out the coin dealer up there, was able to buy some of these silver dollars from him. She said it was a very friendly gentleman named Cameron who helped her out, and she said it would be greatly appreciated if I gave him a shout out here on the channel. So anybody who happens to be traveling through Colorado or is in the neighborhood of Arvada should check out AAA Jewelers and go talk with Cameron and see what kind of deals he would work for you. Alright, in today's video we're going to talk about the debt ceiling. We're going to talk about this U.S. Treasury debt limit that had been suspended and that will be reinstated, and if the debt ceiling is not raised for more borrowing capabilities or suspended again for the capabilities of borrowing, then the Treasury will be moving into extraordinary measures to deal with the, issues of not being able to have the funding to work the government's programs like they do today. I don't know how else to explain it more simply than that, but basically they run out of money and they have to step into extraordinary measures. Now, this is something that the United States has faced many times in the past. This isn't new, right? This raising the debt ceiling or hitting the debt limit is something that we have faced many times in the past. And there has never been a single time in all the times that we have hit the debt limit have we ever not raised it. There has been times in which that we have shut government down, we have gone into the extraordinary measures, but ultimately, at the very end of it, we always raise the debt limit, we always borrow more, and we always go into the future in that operation of debt issuance and further into the kicking the can down the road, right? However, the arguments will be quite extreme, and there will be a lot of threats back and forth that they will not sign the deal and that they will hold back on it, and that there will be all kinds of government shutdowns and chaos will ensue, and everybody's going to lose their minds and retirements and jobs and everything else, right? So plenty of that will be spoken about during this time, and it will be a lot of political pull one way or the other, right? In order to get the deals that they want before they will finally say, yes, okay, I agree to this debt limit, or this new raising of the debt limit, or the suspending of the debt ceiling altogether. But the fear and anxiety that comes from the idea that they would actually default, like what would that really look like? The United States has never defaulted on their debts, ever. And when you think about like the United States Treasury being the safe and liquid asset that the world uses in place of essentially gold, right? Like how gold was the world reserve currency and how everybody used gold for that safe and liquid asset, now is used as U.S. Treasuries are used in that place. And so when you think about like U.S. Treasuries all of a sudden heading into a defaulting and people not getting paid, you're talking like insurance companies, retirement funds, municipalities, sovereign nations around the world, all these people all of a sudden having a balance sheet that then gets basically wiped out as the main asset that sits there is now defaulting, and nobody knows where and when and who is going to have a defaulting bond. So this is really difficult for a lot of people to wrap their heads around, to understand like what this would actually look like if there was a debt default from the United States. Now, I've thought about this many times, and I thought, okay, so let's just assume for a second that we have everybody who has a hold of a bond, a United States Treasury, right? A security, what else do they call them? A sovereign, right? There's all kinds of names for this when it comes to the bond issuance coming from the United States Treasury. But when you think about people who hold on to these things, if that was to go into a default, meaning that they are not going to get paid, the coupon's not going to get paid, the face value of the bond doesn't get paid, the Treasury doesn't have the money, bonds are going into default. Now, this would be incredibly dangerous for the financial system, for the markets, for everything around the world. And the Treasury knows this. So if it was, say, a hypothetical situation in which not only the Treasury, but the government and the Federal Reserve are going to step up and do something about a default, what would that stepping up actually look like? All right? Because if you think about it, a United States Treasury defaulting is now turning into essentially a toxic asset, right? It doesn't pay. It was like the mortgage-backed securities back during the great financial crisis, turning into a toxic asset. Same thing. It's a toxic asset. It doesn't pay anymore, and it's failing. So why would you want to own it? Or how could you possibly sell this to anybody else who's going to want to take possession of this thing knowing that it's probably not going to get paid, considering that they're defaulting? They don't have any money, right? They can't take any more money out to pay for this one, so why would you believe that it's going to get paid into the future? What would give you the want to buy it? None, right? There would be none there. And so now the Federal Reserve, who has in the past dealt with a situation very similar to this, when it came to the great financial crisis and those mortgage-backed securities and the defaulting of these mortgage-backed securities, or at least the toxic asset related behind them. So who's to say that the Federal Reserve, who is sitting on an insane amount of treasuries themselves, who may have some that are in that toxic asset category, but not all of them are going to fail. Some of them could get paid. I mean, there is tax revenues, there is money that comes in. So we're not talking every single bond defaulting. We're just talking some of them are defaulting and nobody knows which ones. So the Federal Reserve can say, hey, those toxic assets, those bonds that are failing, well, here, why don't you give us those? We'll put those on our balance sheet and we'll give you some bonds that are not toxic, that are not failing. And we can keep those toxic assets off of the market. Okay? See, this is a capability. This could very well be one of the options that the Federal Reserve could use in a defaulting type of situation. Like, nobody's talked about this. I mean, I imagine some people have probably theorized on it. I mean, I had to hear it from somebody, right? So, but this isn't something that's talked about within the mainstream media, I don't think, right? It's definitely not something that I've heard the Federal Reserve communicate. But it is something that they have done in the past in a similar situation. And then I also think about it, it was just like, we got these trade wars going on. We already have, like, kind of issues with partnerships falling apart and trying to figure out how to bring manufacturing back to the domestic supply, right? Instead of using foreign production for our supply. And when you have this idea out there, it was just like, well, really, if we have this trade war thing going on and all these nations around the world are sitting on U.S. treasuries as the safe and liquid asset, who's to say that the Treasury can't just pick and choose which bonds are going to default? Like all the Chinese bonds, or all the few $1 billion worth of Russian bonds, or $1 million worth of Russian bonds, U.S. treasuries that the Russians own. Like, default on those ones. Like, pick your enemies out there who are sitting on your treasuries and just don't pay those particular ones. I mean, it's all computerized now, so it's not like you don't know, right? See, this is some of the things that I think about, like, could take place if we actually have a debt default. It can actually turn into a weapon. In fact, defaulting on purpose, knowing who it is that you can default on strategically, can be used as a weapon against those people. They would start to destroy their own currencies, right? Start to destroy their balance sheet as their safe and liquid asset is defaulting, while everybody else who's essentially owning the same thing doesn't. Okay? See, this is how the United States can combat some of these things. I don't get scared about the debt ceiling. I don't get scared about the idea that the government won't raise it or that there's going to be defaults. When I think about what the default would really look like, I think about it looking like a weapon against the enemy of the United States. That's what I think of. It's not going to be used to punish the American people themselves. They need the trust of the American people. And how much more trust could you get than to see the United States actually using the defaulting of their debt against the enemies of the United States in a way that punishes them, okay? While everybody else succeeds. It couldn't work out more swimmingly than that. All right, we're going to keep this a fairly short video. We're 10 minutes into it. Let's read through some of these comments and see if we can continue this discussion on. All right, the prepared Californian says, unless you work at Kaiser, you have no idea how stressed out Kaiser employees are. Totally not worth the stress of working at Kaiser. The place almost killed my wife with the stress. Wow. All right. That was a hell of a comment. All right. They print and make the debt worthless. Yeah, but then this debt ceiling is going to come up, and you're going to watch the debates and the anxiety rise, and you're going to watch how, like, all these people who are talking about the political pull from one side to the other, and they're going to use it as leverage against each other, and there's going to be all this talk about it, and then at the end of the day, they're just going to print, right? So why is it that we have this debt ceiling to begin with? What's the point of it? Like, I mean, if we're just going to be printing and everybody knows it anyway, then what would be the point of having a debt ceiling to begin with? And so that this moment can come that people actually believe that they would be somewhat responsible, but really they never have been. So really this is all about a political pull, one way or the other. That's really what it's all about, because we know they're going to raise it. And then even if they don't, I believe the ideas, the strategies that I have described that could come as far as an actual default, chip picking and choosing who it is that you default on, right? Buying the toxic assets, the Federal Reserve doing that, like, these are, I believe, like, real concepts that would take place. Like, the Fed has already demonstrated some of these things, so I don't see why it wouldn't take place in the future, you know? All right, moving on. All-nighter up in the house. I love it. All right, Michael. Gold and BTC are meant to be liquid, so they get sold when people need liquidity. Yeah. And you think about it, like, in those situations when Bitcoin and gold are used to, like, in a safe haven situation, but then the safe haven is away from a failing dollar, like, what are you pricing your gold in? You're like, woohoo, it's $1 million now, but do you really want the $1 million? Like, if it's up to $1 million, it means the dollar is getting worthless. Why would you want to trade into that? See, this is where I look at, like, a lot of times when people are pricing out Bitcoin or gold in dollar form, and I'm thinking, well, are you planning on selling it at some point in dollars? Because you bought it because you think of the dollar being worthless and that it's going to fail and that it's not going to, you know, it's not, there's no point in having the dollar in existence anymore. That's why you're in Bitcoin and gold. But then it's priced out in your mind like, oh man, once it achieves $1 million, I'm going to cash out. You know, and it's just like, so you do want to be in cash, right? You know, you do want the cash concept out there. You want the cash concept out there and hoping that maybe if Bitcoin and gold, now I'm not saying you personally, maybe me, maybe this is just me, right? I'm speaking for myself, right? And that if the Bitcoin and gold can move up in an incredible value comparatively to a devaluing dollar, well, then I can sell my gold and Bitcoin for an extraordinary amount and then pay off my debts that I have incurred here while the dollar is still somewhat valuable. Like, I would still want the debt system to be in existence, right? For me to take advantage of that. If the debt system completely fell apart and then I couldn't use the dollar anymore and I got to pay off this house in dollars that I can't acquire because the dollars are disappearing because the debt issuance is going away, then that's going to make it very difficult. Like, even if I was to sell the Bitcoin and gold, if you have a devalue or a not money printing, but actually money destroying because of the lack of debt issuance, because that's really what it is. If the more debt issuance you have, the more dollars you have. The less debt issuance, the less dollars are existing. So if you have a collapse of the debt issuance that is happening out there because people are scared of the dollar, then how is it that I'm going to acquire the dollar to pay off my house? Right? It's going to become ever increasingly more difficult. In a deflationary situation, that is hard. Now, granted, I mean, I'm somewhat prepared for that idea, right? I mean, we'll find out in the end if I actually am prepared enough, but I mean, at least thought about it and somewhat, you know, considered what it would be like in that sort of situation and how to deal with it. But for the most part, that's going to be very damaging for most people too on that direction. So it's always going to be about expanding of the money supply. That's the way the debt monetary consumer system operates. It's like more consumption, more debt issuance, you know, more more progress in that direction. It's not progress, it's just like, more, I don't know how to quite put it, because every time I describe it in this way, people say, man, you're describing it in a way like you're in favor of it, and I'm not in favor of it. Like, I'm not in favor of any of this. The more debt issuance you have, the more printing of money, the more separation between the rich and the poor that occurs because of it. But also understanding that the exact opposite of that is going to be pain and misery for most people out there, as they are not in a position in which that they can handle a deflationary economy, as most people are reliant on a debt consumer system. Right? And that's because it's just evolved into that. Like, to all of a sudden switch to something else, I just don't think the people could handle it, and you would find a lot of pain and misery on account of it. So, and again, like, if that's the way we go, that's the way we go. I've thought about it, and I think, okay, well, I know how to handle myself in that situation, but I just don't think most people do. And then time would tell if I knew how to as myself, but at least I thought about it, All right. How many people use cash now anyway? You'd be surprised, Ray. I work retail for a living, and it's surprising. Granted, most people use debit, and they actually have an account with my store, because I work at a lumber yard, right? So people have an account with the store, and most of them would be using debit cards. But it's surprising how much cash transactions actually take place. It's quite a bit. All right. We will all be working for BlackRock's Aladdin. About that. Hey, I'm hearing around January 15th. Well, yeah, there's no doubt in my mind that we'll be entering into extraordinary measures, right? The Treasury, and they'll be talking about them like they've never done this before, but they do it every time the debt ceiling has been hit. Like, I remember Timothy Geithner talking about it way back in the Great Financial Crisis, and everybody all lit up on these extraordinary measures and that they're going through. But just think about it. It's extraordinary, right? Outside of the ordinary measures that they would take, these are the extra ones that they would ordinarily do, right? Extraordinary. Extraordinary measures sounds like really, like, oh my God, never before, this is the first time kind of thing, but it's not. It's just the system that is built outside of the system that is typically done, right? If this is hit, then this is the extraordinary measures that we have to go into in order to conduct ourselves during this time. If it continues, right, and you're right, and you go on to January 15th and you start seeing parts of government shut down, less bonds, like, there's never been a bond defaulting taking place. So if that was to actually happen, then we would see, okay, well, wow, man, this is the first time it actually occurred. What is it that the banking system is going to do about this? And I would assume that the Federal Reserve would step up and say, hey, give us those toxic assets and we'll give you these bonds that are not toxic, that are paying, and then there will be no toxic assets out there in the market. They'll all be sitting on the Federal Reserve's balance sheet, just like the mortgage-backed security. So, I mean, that's kind of what I see happening. Like, so, I mean, my concern over it is really low. Like, it's so low, like, it's almost to the point that I just don't even, like, I don't even really think about it being a problem. I mean, I think there's going to be a lot of communication. I think there's going to be a lot of anxiety built up over it. There may be some political pull one way or the other, but ultimately the debt will continue, All right. We can't keep working for other families. Simon, I've been watching this one guy on Twitter talk about the yen carry trade. I'm curious what you thoughts on how you think this ties in. I mean, to be honest, I haven't really been focusing in on a lot of that whole yen carry trade, as far as, when you borrow in cheap yen, invest it into the U.S. Treasury debts, and then all of a sudden you start having the yen rise as far as the yields go, and then paying back that yen gets very difficult. And you start finding the unwinding of that and what it is that they had taken that money and invested into. So now having to undo all that stuff. You sell the asset to pay off the borrowed money that you had done in order to buy those particular assets, and this is all done in this, like, kind of obscure way of borrowing in yen and invest it into the U.S. Treasuries, and then going putting that towards an asset or something of that nature, like borrow it against that and going into an asset. There's a lot that ends up tying together, and I'm not so savvy on this stuff that I can say, hey man, this is exactly how it goes down. But understanding that there is some contagion effect that could occur from that, and I would imagine that there is probably some pain that would be experienced, and probably fairly dramatic. But as far as like triggering a cataclysmic kind of thing, I just don't see that being quite the case, right? Like, I think that's probably where a lot of people are concerned about, is like this is going to start, moving into other assets and then start unwinding other parts of the economy that people weren't anticipating happening because of it. And that could very well take place. Like, that contagion effect could very well happen. But in my mind, if we can describe it right now, then there's probably somebody within the financial system up at the Federal Reserve who has also probably paid attention to something of this nature. And they are probably building up some sort of safety net or lifeboat situation in order to contain such a thing. And now, whether or not it's like contained, like the subprime mortgages are contained, that may not necessarily be the case. But to understand that they may have the situation in mind to deal with, as far as some of the tools that they don't talk about to deploy during that time. Like, to describe it simply, like, nobody understood what it was that the Federal Reserve was going to do when the banks started to default. And when Silicon Valley Bank default started to happen, they stepped up with the Bank Term Funding Program. Again, nobody knew about the Bank Term Funding Program before it happened. But once it happened, everybody was like, oh, well, there's the lifeboat that they were talking about, right? Nobody knew what the lifeboat would look like. Nobody could, incorporate that into their strategy, because the Fed is not going to communicate this out there to the people, because once they understood that it exists, then they would start pricing that into their strategy, into their investments. And so, since it's not a measure that is available to them unless you have an unusual and exigent circumstance, nobody knows what it is that they're going to do about it. But again, if we can describe it and talk about it and say, hey, this is going to lead to these particular events, then I'm sure that they probably talked about it too, right? And then come up with ideas and and concepts for dealing with such a situation. Whether they're successful at it, that's another story, right? But again, just knowing that if we can talk about it, they could probably talk about it too. All right, we got 80, 87, 81 people. Well, I can't even read this. Go hit that like button. We got 425 people watching this live stream right now. This is a really good one. I think a lot of people should really pay attention to what is going to be taking place here and not fall into the fear, right? Because that's what's really going to drive a lot of motivation for people to raise the debt ceiling, is going to be the fear and anxiety that is built up behind it. There's going to be a lot of talk of like complete chaos and retirement funds going bankrupt and all this other stuff. And although that's it's a very real, credible threat, like, I'm not denying that, there's never been a time in history that the United States didn't raise the debt ceiling. Or suspend it altogether. Alright. On Pepe coin? Yeah, no, I'm not big into... outside of the cryptocurrency of Bitcoin, and to a lesser extent, Litecoin for me, because I just really like Charlie Lee, and I like the fact that he worked really hard on his project and was essentially like the silver equivalent to Bitcoin being gold. I just don't see anything outside of Bitcoin. I mean, Bitcoin is it. That's it. Like, I don't see, all the rest of them are secondary, okay? There's nothing that these other coins are doing that Bitcoin can't do, or will someday do in the future, using a secondary layer system. So in my mind, I don't know why you would want to go into anything else. Like, I can get it, there's price moves and there's potential and there's some really good projects. Like, that's the other thing. It's the projects behind the coin itself, right? Not the hype, right? Not the pump and dump kind of idea behind the coin, but the legitimate project behind the coin that's using this coin. It's not the coin itself, it's the project that's behind it. That I could see, somebody maybe looking at that kind of aspect of it. But again, whatever it is that they're doing with that, I just feel that Bitcoin would be able to duplicate it with the secondary layer system or whatever. So I'm into Bitcoin. That's it. Bitcoin is the only thing. Where can I get your embroidery fed hat? This one was actually given to me as a gift, so I don't know, go buy a hat and have an embroider do it for you. That's what That's what we did. That's what the person who gave it to me did. And this is a hat. This hat is old. This is back from the Ron Paul running for president back in the Fed days. None of this new hyped up stuff. I mean, this is one of the OG ones. All right, keep building on lightning. Bitcoin can't survive indefinitely on its own. You don't think so? I don't know. Maybe. All right, when will QE start? Like quantitative easing? When will quantitative easing start? I don't see it. I don't see quantitative easing starting up anytime soon. I mean, that's I don't know. Like that one, I don't see the signs of quantitative easing coming in the future. I see more signs of staying tight, quantitative tightening. I see restrictive monetary policy for a while, like higher for longer. The Fed is getting high and staying high. I've been saying that since they started raising rates, that they were going to get high, and stay high for a while. They stayed extra low, extra long for an extended period of time to create an inflationary scenario that will now require them to stay extra high, extra long for an extended period of time to make up for the fact. All this is now how they operate. Flexible average inflation targeting going into the future. They will never, ever, 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 ever be at 2% on an inflation target. They can't. They've tried. They can't do it. They tried to do that. They tried saying, hey, we're going to be at 2% all the time. If we're above 2%, we're going to bring it down to 2. If we're below 2%, we're going to bring it up to 2. We're going to try and maintain 2%, and they failed. They can't do it. Period. Right? And so this idea that they're going for 2% is just completely delusional. They're going for average inflation rate over time, which means that the appropriate monetary policy will likely aim to achieve inflation that is moderately above 2% for some time. Now, this is their words, not mine. I'm not making this stuff up. That's a direct quote from them, from their monetary policy strategies. So, in my mind, there is no quantitative easing coming. They don't have that in mind right now. They have a restrictive monetary policy going into the future with an elevated inflation expectation that will raise the neutral interest rate. If they continue with this inflation expectation being elevated going into the future, the neutral interest rate will rise and eventually meet the Fed funds rate. Now, whether the Fed has to bring those rates down some or more, a little more or less, whatever they have to do in order to achieve the neutral is on its way to achieving them, to meeting them. And that's really where I believe the Federal Reserve wants to be, is at neutral. Right? Which means that they are neither accommodating nor restricting the economy. So this idea that when are they going to start firing up QE, I don't see it. I don't see it anywhere in the future. Not in the near future anyway. And the idea that we're rolling into recession, how long has that been going on? We've been talking about rolling into recession for a couple of years now. I think my idea of the recessionless recession is finally proven itself to be true. Now, again, we may roll into recession anytime now, but the unemployment numbers don't really seem to be showing that, as far as still being historically low. Even though we have massive amounts of layoffs, those people who are getting laid off are finding work at the service industry that had an incredibly huge amount of shortage of workers. It's not a great job, but it's a job. And if you have a job, you're employed and you're not unemployed, and that's one of the reasons why we don't see unemployment rising. So again, it doesn't mean that your people are doing good. I'm not saying that. I'm not saying that at all. People aren't rolling in and saying, hey man, we're in the money, we're kicking ass. That's not what I am saying at all. What I am saying is that the recession that people were anticipating didn't come because of that reason. Their high-paying zombie corporation job is failing, and now they have to go work flipping burgers and serving beers, and they have a job. And that's it. That's the case, right? And it sucks for them, I know, because their money is now short, their expenses are up. And so it's it might feel like a recession to them, but they're not counted as unemployed. Part of the dual mandate coming from the Federal Reserve. If unemployment is low, then they don't have to worry about that. All right? They don't have to worry about that part of their dual mandate. They only have to worry about the other part, which is low inflation with stable prices. They don't have a set course on interest rates or on inflation or on any of that. There's nothing set in stone that says the Federal Reserve is obligated to be at 2%. That's not, they just make it up. It's all arbitrary. They can set it at anything they want. And what they have done is they have said, hey, we want inflation averaging 2% over time with an inflation expectation of 2%. And that's it. Like, appropriate monetary policy may be something completely different at the moment, right? In order to make up for the fact that they failed to achieve that 2% target, whatever the hell that is, since they've never been able to do it. What the Okun's? What the heck is Okun's law? Oh, that's a new one. I'm going to go look that up. All right, every 1% increase in the unemployment rate equals 2% or negative 2% in real GDP. Yeah. And again, like, is that real? Like, not like, is the unemployment number real? Is the GDP number real? Is any of that stuff real? Like, the reality of the situation could be far different from it, just like the reality of the situation of people being employed. They're like, oh no, man, look, the really low unemployment numbers. Like, yeah, but everybody has a crappy job. What difference does it make if it's low unemployment if everybody's, like, earning, like, half of what they did? It doesn't, like, it might as well be unemployed, but they don't count as unemployed. And then even still then, like, the unemployment numbers, the official unemployment numbers, are probably very skewed considering what it is that unemployment really is. Okay? So none of these numbers really make sense when you start comparing them. I want to compare GDP to the unemployment to all these other things. And to me, it's just like, okay, well, then it gets very tricky to understand what it is that's happening within the economy. Like, it's not tricky to understand what's happening with the economy for the reality of it, but it's difficult to understand what's going to happen within the economy according to the Federal Reserve strategy and their monetary policy, considering the things that they are looking at. So when I look at it, it's just like, okay, all these numbers, you're right, are very obscured, but the Federal Reserve is going to act upon the unemployment number itself, and whether or not it's skewed or not, if that unemployment number is low, then they are probably going to stand still, right? They're not going to adjust on the account of the unemployment if it's low. And so again, if they forced it that way, or if it just happens to be that way, they're not going to move. I know that I can look at the Federal Reserve and say, you guys are doing it wrong, whatever that means, because that's just my opinion on it. But I can tell that they're probably not going to act upon the unemployment if it's low, right? Because it's part of their dual mandate, low unemployment. That's successful to them, whether it's fake or not. So again, like, understanding how they look at it and what they're going to do amongst according to their strategy, like, because I can't make them do it the way I think they should do it, and even if I did make them do it the way that I think I should do it, who's to say that's appropriate for you? Like, it would be appropriate for me, but I mean, who knows for you in the position that you have taken. So I think it's better to look at it like how they are looking at it, so that we can see what they are seeing, so that we can act accordingly to what it is that they plan on doing, because there's nothing we can do to change it. Did I say all that right? Am I making sense on that? Thanks for the stream, Yui. Your time is valuable. Yeah, you guys are awesome. I'm going to have to cut the live stream here short. We're going to give it just another couple of more minutes. I got some things I need to go do in town. But I think this was a really good topic that we needed to discuss. We got 500 people watching right now with 129 likes. Do me a favor, guys. This stream is going to come to an end here in just a few minutes. With 500 people watching right now, go hit that like button. By going and hitting that like button, you're going to be supporting the Uneducated Economist. YouTube will pick up this video, spread it around for more people, and we can continue this conversation after the video is uploaded. So, yeah, go hit that like button and support the Uneducated Economist. I'm not against 420, but keep in mind the THC levels in what people are smoking nowadays is pretty high. Yeah, the prepared Californian. Yeah, I agree with that. But I also come from an area in which that weed has been very, very prevalent. Like, it's never been a crime in Oregon. It's always been a misdemeanor if you were in possession of marijuana. Less than an ounce, and it wasn't packaged for sale, and you weren't producing. It was a misdemeanor. You paid a $600 fine, and you were on your way. Like, they confiscated it, you got fined, and you went about your business, right? So as long as you weren't doing something else, like production, selling, driving, right? If you weren't involved in any of that stuff, nobody cared, right? Nobody cared about it at all. So I come from an area where weed is incredibly prevalent. Like, it's everywhere, right? It practically pours out on the ground. There's almost no value to it here. And I had a buddy who loved smoking the stuff. Like, I mean, he smoked it all day long from the time he got up to the time he went to bed. And I watched him with some really high quality weed take like 30 bong hits in a row. And, he didn't really act much different from the second and the third one that he took from the last one that he took. It's like after a while, it didn't seem like it was doing anything to him anymore. His tolerance obviously was so built up that, really after those first initial hits of it, it didn't really do much for him other than keep him on that higher plane, and he didn't really even act that much different. Like, you can kind of tell he looked a little tired and drained, a little more goofy than normal, telling more jokes and stuff. But outside of that, it's just a regular normal dude, just like everything else out there. And that's what I found most people around who are chronic habitual smokers of marijuana, is that really it doesn't do anything to them anymore other than, it's like they're the same, only different, right? That's it. There's no difference. They're the same person. All right, Yui, thoughts on lenders closing only about 15% of deals across all major cities in the U.S.? I don't know. Is that really the case? 15% of all deals? I don't know. I got to look into that. Compare that to previous numbers. All right. The point of the debt ceiling is so the party out of power is so the party out if power K? I don't know what that. All right. Let's see here. The Prepared California. I have met some people that actually need weed. All right. Because rate adjustments are no longer the effective tool. That's right. Rate adjustments are not the effective tool. You can see it. Right? You can see it taking place right now. All right, 36 minutes. Okay. But we'll just end it with this one. But you can see that the rate adjustments are not the effective tool, right? Understanding that even when the Federal Reserve adjusts rates, that there is a lag time, right? Anywhere from 6 months to a year, even 18 months, some people will say that it takes before those rate adjustments fully impacts the economy. And you have to think about it. Because the Fed lowered rates, assume they did it yesterday and today, we take advantage of these new lower rates that are now seeping their way into the economy. Let's take it in, for example, that's what would occur, right? We're hypothetically speaking here. So the rates come down, we're going to take advantage of it. How many people are actually going to run out and be able to take advantage of a lower rate tomorrow? Right? Probably very few. There might be one or, like one or two. There might be a handful of people who are going to be able to take advantage of that right away. But for the most part, it has to be in the system for a while for people to then be able to then use that lower rate for their business, for their projects going into the future, for whatever consuming they want to do. Right? So this is why it has a lag time to it. And then even still, with a small rate cut of 0.5%, it's significant on the Fed funds level, but really when you think about it in the grand scheme of things, it's not like it's an extraordinary amount of money, right? Or extraordinary amount of interest rate cuts, like taking it from 5% to 0. That would be intense. 0.5%, yeah, it's big in the idea of it, but in the reality of the situation, 0.5 percentage point isn't exactly an extreme amount. So when we think about that 0.5 point cut that was deployed by the Federal Reserve and their interest rate cutting capabilities to try and stimulate the economy, or at least be the non-restrictive economy, or a less restrictive economy, I guess that's probably the most appropriate way of saying it. That effort of interest rate cutting still has time before it actually starts to impact the economy in a meaningful way. So it hasn't yet done anything. Right? Now, the idea of it's had a profound impact on the markets and their behavior. But the actual cutting of that rate and that lower interest rate will still have a few more months before it starts to impact the economy in a meaningful way. There'll still be another, 6 months after that before it really starts to impact it in a way that is profound or fully impact the economy. So right now we're sitting in a position in which that the interest rate adjustments really has no impact on the economy yet, right? I mean, it does some, but not fully, not in an extreme way. And there's already talk of adjusting how much interest rate cutting they're going to do, meaning they're going to do less of it going into the future, saying, oh man, economic conditions, we don't know. What they have already done hasn't even impacted the economy yet. They're already talking about reversals. You see? It's all about the communication. The interest rate adjustments hardly have anything to do with the economy right now, because it hasn't had time to do it. The belief of it is profoundly impacting the economy and the markets, right? Mainly the markets, not so much the economy, but it does in time, right? And the more people communicate about it, the more of an impact it does have on the economy. So this is what we're experiencing right now, is a whole lot of communication, rumors, expectations, but not a whole lot of reality coming from the actual cuts themselves. That's going to happen here in a few more months as time goes on. So again, like, I just look at it as like, I don't think about the actual rate adjustments being the profound monetary tool coming from the Fed. It's their spoken words. It's their expectations that they are delivering out there for the people. That's the main policy tool coming from the Fed. All right, guys, I gotta go. Uneducated Economist, thank you for being here. We got 500 people watching. Thank you so much for joining in on today's live stream. All those who are just now joining in, sorry guys, I gotta go, but you come back and watch the video again and come back to the comment section, leave a comment what you believe is coming from the debt ceiling or suspending of the debt ceiling, or how much further they're going to raise the debt ceiling, or maybe even possibly default, and what that could look like. So, Uneducated Economist, you guys let me know.